really, really fun topic, and it all is going to be going over how to analyze a deal. All right. And not just any type of deal, but mainly, I think we're going to try to focus on some multifamily investments. So lately, we have been seeing so many people leverage and utilize their IRAs to do some form of passive investing, right? We see a lot of people pulling away from owning the individual properties and trying to find more ways to be a passive investor. So if you want to be a passive investor, you need to understand how to analyze every single type of investment. So we have a specialized speaker today that's going to be going over this topic just for you guys. Real quick, as we go ahead and get started, if you notice, if you're on Zoom, in the chat box, you can ask any questions you have. You can pitch investments you have, or you can just be like, hey, I got some money, I'm looking to park it someplace, right? So please feel free to pitch your own investments, pitch your own stuff, and always, always, always do your own due diligence. So quick little disclaimer from Quest is, remember, guys, we don't ever vet anyone's transactions. We can't tell you if it's a good or bad deal. As a matter of fact, we even get to charge you a fee if it's a bad deal. So make sure you're doing your own research, your own due diligence, which is one of the reasons we wanted to host this class today. Now, right before I bring on our speaker, I wanted to take a moment and talk about a humongous event we have coming up this week, right? And this week on Friday is our QuestCon event. Now, if you notice, instead of me bringing up a PowerPoint, right, because we all been through those PowerPointed presentations, I wanted to go ahead and show you guys that you can come right to the Quest website. So if you go to questtrust.com, right, you'll notice you can hover your mouse over events, click on Quest webinars. Now, once we go ahead and click on this, you'll see we have a bunch of webinars coming up over the week, and we have the QuestCon event right here. And it's going to give you some information about it. This event starts on Friday and ends on Saturday. So it is a 2-day event. Okay. And as we're thinking about what is QuestCon, why do I want to go? Why do I want to attend it? Right? What we do is we bring in speakers from across the US, and they're all here to educate and talk about different topics related in real estate, whether we're talking about mineral rights, multifamily, single family, notes. We bring in a panel of attorneys to talk about things from asset protection, right, and taxes, and even answer some of those hard questions on entities. So this is going to be a really, really fun event. If you would like to grab a ticket, all you have to do is go ahead and click here, click the big green ticket button. Now, if you notice, everyone misses this. Enter a promotional code. We have one of our marketing people not here today, but she looks really good if you enter the promotion code Haley30 with no spaces. Right? If you notice, tickets are cheap, guys. They're $70. But you enter Haley30, click apply. Man, guys, you can get a ticket for $50. It is all online. You get to network with the speakers. You get to network with the attendees. As of today, we have 300 people already purchased their ticket. So if you would like a ticket, it's $50, guys. Grab one while you can. Our cap at this event is 600 people. So everyone always waits to the last minute. If we hit that, that's as many people as we can hold on the webinar. So make sure, guys, you grab those tickets while you can. Go to questtrust.com. All you have to do is click on Quest Webinars and then click here to get more info, and you're done. So without any further ado, I want to take a moment and bring on our guest speaker, Feras. Feras, are you with me today?
Yes, I am, Derek. How's it going?
Doing fantastic. So, guys, if you've never had a chance to work with Feras here, he has offices right down the road from us. He's been working with Quest, spoken at several of our events, and has really done a lot of unique things with so many clients from across the U.S. So he's going to be talking today a little bit about multifamily and really how to analyze an investment. So, Feras, I'm really going to let you take it away. I'm still here. If anyone has questions, you just let me know.
Absolutely. Thank you very much, Derek. And I think it goes both ways, right? Speaking at your events, and you guys are definitely, one of our favorite sponsors. And, we have many, many investors that use Quest IRA. And, candidly, being kind of on the operator side, we work with different IRA companies. And definitely Quest IRA is one of the best suited, I think, for real estate. So that's nothing to do with this. That's just me being completely honest, right? So usually things are very, very quick with you guys. So,
dude, you're the best, man. Thank you.
Absolutely. So I'll go ahead. Let me go ahead and just share my screen. So without further ado, can you guys see that?
Yep, we can see it just fine. Looks good.
All right. All right. So with that said, I'm going to go ahead and walk through this. So again, thanks for having me, right? For those that are just tuning in, we're going to go through basically, passive investing 101, specifically for multifamily, right? What are some of the things to, look for and really kind of go through a little bit of the life cycle of what it takes to passive invest, I think is kind of really the general goal. And so with that said, maybe kind of a quick overview on myself, right? I have a company called Disrupt Equity. My background software, I used to work in Microsoft and then got into real estate. And really my first real estate purchase was actually a fourplex down the road. It's a coincidence. They're literally a mile from our office now. And, kind of from that really got into multifamily, fell in love with it. It's a systems, operations, and kind of people game. And so started Disrupt Equity, me and my partner. And, Disrupt Equity has grown. So we currently have properties throughout Texas and Georgia, right? Currently about 1,500 units. We've had several deals that we've sold and gone full cycle on. And, as Disrupt Equity's kind of grown, we've been able to grow other parts of the business. So we kind of have our own in-house management company. We do have investoracademy.net, which is really kind of an educational side to investors that want to learn what everything is about. So that's been something that we've been putting together, growing that, as well as, a few other businesses from Peak Financing, Strategic Insurance, and then last but not least, our conference. And so, would love to have people out. We are going to do that next one, February 27th. So we definitely decided to kind of do it again here in Houston. So looking forward to that. But with that said, really the goal today is to kind of run through, kind of these pieces, right? We're going to go through just a little bit about what passive multifamily investing is about, right? Digging into kind of the criteria, how to find other deals and operators, right? How to find a deal. And then from that, how do you vet that person, right? And then how do you vet the deal? And really just what that process looks like. And then open it up Q&A. I love doing Q&A. I think it's the most valuable thing to most people because I think people always have questions, and rather, I can't guess everyone's questions, right? But I can definitely answer questions for people, right? So, definitely Q&A is a big part of it. And for those of you out there, please don't hesitate to ask questions. I'm a candid guy. I'm very transparent and open. So, I'm here for you all and want to help kind of educate everyone. And so with that said, right, why passive investing, right? We love it because it's why multifamily is what I meant to say. It's real estate, right? The same reasons we like all real estate. There are multiple pillars to real estate. And, coming from the tech world, there's a lot of people that have a lot of money sitting in the stock market. They don't know anything about real estate, and they all kind of have a very naive approach to real estate, right? Because they search stock market versus real estate. What do they see? They see that real estate appreciates over 2.5% over, each year, whereas the stock market averages 11% a year, right? That's pretty much it. So they say, okay, 11%, 2.5, clearly it's not good. But there's components that make real estate a very powerful investment, probably the most powerful investment, right? And it's things like you are getting cash flow, right? So appreciation is one thing. Appreciation only matters whenever you sell the property. But, you're getting cash flow. You're getting tax benefits, right? These are huge. And some of our more experienced investors, their number one reason to invest is for the tax reasons, right? Like Donald Trump said, whether you love him or hate him, he did say he doesn't pay much taxes, and it's because of real estate, right? It's phenomenal how you can, if you know what you're doing, right, how you can really reduce your tax burden. With that as well, right, we buy deals, what we call, value add. We can do what's called forced appreciation. And I'm going to go over it a little bit later on how these deals are valued, but we can do things to actually push the valuation higher, right? And then last but not least, really leverage. There is such a good thing as good leverage and bad leverage. Racking up your credit card bills, buying TVs and other random things, not the best kind of leverage. But leveraging an investment into real estate, right, where your $2 million can become $10 million is very, very powerful, right? Because, you're basically multiplying, what the power of your money. And last but not least as well, you are able to use your self-directed IRA and solo 401ks in, multifamily investing. We have a lot of investors that invest with it. And as I mentioned earlier, Quest IRA has been great with that. Right. But before you kind of get into multifamily, and again, my goal is to just touch on a lot of things to help people jog people's memory. Please, everyone, ask questions, right? So with that said, so really the first thing to kind of understand, what is your investment criteria, right? How much do you have to invest, right? Are you looking for cash flow? Or are you looking for appreciation? We have some investors, really the best example is people that are retired, right? They're looking to turn their money into essentially income, right? Immediate income. So they're looking for deals that we're going to start distributions very early. We have other investors who maybe they're younger, much longer horizon. They're not necessarily looking for immediate income, but they're looking at how do I triple my money or double my money, right? The thing, they're looking for maximum gains. And so as an investor, that's probably the first question to ask yourself, right? How much do I have to invest? And really, am I looking for cash flow or appreciation? Along with that as well, right? Thinking through, what kind of returns you're looking for. And so in multifamily, right, there's a couple of, and I'm going to go through some of these a little bit later. There's a couple of metrics that we look at for returns, right? One of them is IRR, and really, I'll come back to IRR in a second, but the first one is really, what is my cash flow, right? We mentioned that one. The next one we really look at is, what is my average annual return? So over the life of the deal, how much are you averaging yearly, right? And again, if you think about two different scenarios, imagine a deal that we bought it and sold it for the same price, so we didn't make any income on the sale, but it cash flowed 20% a year. That would be an average annual of 20%. Imagine a different deal that basically we bought it at a price, we sold it at double what we paid for it, right? And we made zero cash flow. That's also 20% average annual per year, right? So that metric is kind of giving you over the life of the deal, but doesn't tell you much during the hold. Now that's where IRR comes into play, right? IRR is really, it's complicated for most investors. And if you don't understand it, we do have something on our website that kind of helps explain to people what it is. But really, IRR is about the velocity of your money, right? Think about compounding interest. It's really that kind of principle, right? Where, hey, if I would have gotten cash, my cash could have made more cash, and therefore, I made more. So if you really think about that example I gave, where both of them are 20%, in the deal where we got cash flow each year, that cash flow that I got year one, I could have reinvested. And then year two, I could have reinvested that. So my IRR, right, the velocity of my money could have been much higher with that deal than the one where we just bought and sold and doubled our money at the sale. And so, again, as an investor, you need to think about what returns you're looking for, what IRR you're looking for, and, what type of assets and area do you want to invest in? And we're going to go through some of the questions to ask yourself to help with that. But it's important, right? I think, most people think of an apartment, they think of that swanky A-class property that's, maybe something like City Center, right? That's not usually what we're buying. Those deals don't really have much returns, right? And so just getting comfortable at understanding, okay, we're buying more, B, C type of assets, right? We're getting better price points, higher returns for those. And so those are the kinds of deals that we're buying. But that said, someone is buying those deals in City Center, right? Usually those are life co companies, right? Big life insurance companies that aren't really looking for much returns. They're looking more for parking their money, right? And so different deals, different strokes, different folks. And, that said, also, it's good to understand what the returns are in the market today. And I'm going to go through some examples of what they are, so to kind of help give people some kind of gauging indicators. But again, it's important as an investor, these are the first set of questions to really kind of ask yourself, so you can start to align what you're looking for fundamentally with deals and operators. So with that said, right, the next question most people ask is, how do you find deal sponsors and investment opportunities, right? It's all about networking. What I love about real estate, it's absolutely a networking business. It's about who you know, who they know, and who knows them. And so, get out to events, right? We have a big meetup that we do here in Houston. It's been on pause because of COVID, obviously, but we have the largest multifamily meetup. We host that every month. And, we meet investors, we meet partners, and I met my partner there many years ago. And so getting out to these things, because it's about getting educated, right? At meetups, you meet people and you get educated and you learn, who knows what they're doing and maybe who doesn't, right? Webinars is kind of the new phenomenon that's going on now as well, right? They're becoming very popular because of COVID. And again, there's tons of these types of things, right? And last but not least, networking conferences, right? QuestCon, get to go to QuestCon. Let's go see who's asking questions and who's not, and who's answering and who's not, right? Get to know other people. And maybe last but not least as well, we have a kind of a group called Multifamily Masters that we help run, which is really a national meetup brand, right? And, again, as I mentioned earlier, we have our conference, Multifamily Investor Network, coming up as well. And so, there's a lot of different ways to get out there, right? I think people new to the business are a little bit shy, but guess what? There's a ton of people like you. Don't hesitate to go out, or at least hop on a webinar. You don't have to talk. You don't have to turn on your video. Just listen, right? Get educated. Then that'll lead to maybe you having questions and learning a little bit more about the business. And then from that, right, you go to, you find a sponsor. Let's say you find a sponsor you like. Maybe they're talking at an event somewhere, and, ask them, can I talk to some of your investors, right? Referrals. What deals have you done? What deals haven't you done, right? It's all about vetting that person. And we're going to go through kind of how to vet the sponsor here in a second. But then, from that, contact people, right? Talk to the people writing blogs, websites, social media, right? Just get exposed to them. That's how you start to find kind of sponsors and operators. But then once you have someone, right, how do you vet them? first and foremost, look at their track record, ask them what deals have they actually bought and sold. And I think it's important to ask them which deals have they gone full cycle on, right? Because on our side, it's easy to buy a deal, right? That just boils down to finding a deal and raising the money. It's hard to operate a deal and hit all your returns, right? And not even just during the hold. Maybe a deal's cash flowing during the hold, but maybe you missed the mark on the sell. And so understand, what have they done full cycle, and maybe they've never done anything full cycle. That's okay, right? But you as an investor just need to understand that and make sure that aligns with what your risk tolerance, what you're looking for. And then from that, right, candidly ask them, what is their best and worst deal? I will happily answer that to everybody. I call my worst deal our ugly duckling, but it's going to perform in the end, and we're going to do well. But it's been just a challenge, right? Because worst means, it doesn't necessarily mean it's not performing. It means that it's just been difficult as an operator. And same thing with best. We've had home runs, but I also say, hey, these home runs were not indicative of really all deals. I mean, we did really well, we did our part, but there's other things. And so be willing to talk to a sponsor and ask them the hard questions, right? Really, this is more like a marriage, right? You kind of want to date a little bit before you get married, and you're in this thing for 5 years, whether you want it or not, or 7 years, right? Again, different deals have different criteria, but it's a long-term relationship. And so make sure you get comfortable with the sponsor and don't be scared to ask the hard question, right? From that, ask them, who are they partnered with? Who else is in the deal? Who else is operating the deal? What does that look like? Right? Understanding the investment criteria. Are they doing B, C value add in Houston? Are they doing A-class deals in Atlanta? Right? Just understanding what that criteria is and kind of get comfortable with it. And, with that, it's kind of that's the next point, right? Where are they looking to invest? And from that, right, ask them candidly, do you have any foreclosures, any missed mortgage payments or lawsuits, right? My feedback to everyone, if any sponsor says yes to any of these, you should really, really think twice about it, right? It's been a really hot market. It's hard to screw up, honestly. And, that's maybe not my answer right now. So, but don't be scared to ask the questions, and maybe there's a valid reason for it, right? So dig in, ask them these questions and see how they answer, right? If they waffle, you should ask yourself, why are they waffling? And then, again, ask them feedback for their current investors, right? For us, our best investor is, an investor that a friend told about, right? And what I mean by that is, we've had deals we've done well. Those investors will then tell their friends. And next thing you know, we did this exercise where we had one investor brought us 12 other friends. Those are the best kind of investors, right? Their friend has already done it. They've seen the proof. They understand what it's like. Their friend has told them, well, yeah, it takes time. It doesn't take time, whatever it looks like, right? But they have that referral. It's a warm lead. And so again, talk to their investors and understand what they like and what they don't like. No sponsor is perfect, right? There are things that you will like and there are things that you won't like. And just kind of, again, making sure you have visibility into all of that, right? So next up, right? Due diligence as a passive investor, right? So regardless of what the sponsor says, so any sponsor, they're going to put together a presentation about their opportunity. It's this deal, it's this size, it's this price point, it's this debt, it's this market, et cetera, et cetera, et cetera. Well, you as a passive investor, listen to that, use that in your understanding. But also, I like to actually, someone on our team says this a lot, that, inspect what you expect, right? And really go in and do your own due diligence, right? Understand, what you're getting into. And it's not that the sponsor is not accurate or is accurate. It's more you enhancing your own knowledge, right? Because you might come across something that they don't, and vice versa. So, it starts with kind of the macroeconomics to the microeconomics, right? Population and job growth. Investing in cities that don't have population job growth is hard. So we like cities that have population and job growth. And really the other piece of this too is landlord-friendly states, right? And so, investing in Detroit, yes, I'm sure there are deals to be had in Detroit, not to dog Detroit, but it's still a shrinking city, right? There are less people today in Detroit than there were yesterday than there were 3 weeks ago, right? That's a problem, especially whenever you're trying to lease to people, right? So needing to understand that. We like population growth. We like job growth cities. That's why we like Texas. Houston, regardless of oil, Houston is still a very much a growing city. We like San Antonio. We like Austin. We like Dallas. We like Atlanta, right? That's why we invest in the markets that we invest in. Population, job growth, and the other piece of that is landlord-friendly states. From that, dig in, understand crime rates in the school system. It's not to say that there's not good deals in crime rate areas or school areas. I mean, we have properties with crime, right? It's part of the business, right? Even whenever I lived in Seattle at Microsoft, we had a spousal dispute where a woman shot her husband in a A-class property. crime happens, right? But again, just understanding the deal and the dynamics and what's going on, right? So it's good to understand that, because if a deal is in a really good school system, that's a plus. Now, crime could be a negative, but again, you want the positives to outweigh the negatives. With that, understand nearby retail, universities, key geographic indicators. You're trying to understand who will live at this property, right? Is it the college students that are nearby the college? Is it the low end retail, or is it high end retail? Right? Is it nothing? Right? I mean, we literally, there's properties that are in an oasis, and you really wonder, like, who's coming out here and living at this property, right? We look for things to help make our job easier as operators, right? We look for things that are going to help us perform. Having a brand new development right across the street, that's a plus. That's always helpful. Having just land for 5 miles around each direction, probably not very helpful, right? And again, it's not to say that there's a right and wrong, right? You're looking for things to grease the wheels to make it easier. Continuing down, right? Understanding just average household income and average household value, right? There's a really good rule of thumb, right, that I heard is really, if you think about average income, right, for a average income area, well, let's say the average income is low, $30,000. Do you think $30,000, people that make $30,000 are going to be able to pay $1,500 rent? No. I mean, they're not going to be able to afford that. That's too high, right? $1,500 rents, $30,000 total income a year. That just doesn't make sense. So if you're looking at a deal where the average income in the area is $30,000 and they're projecting getting a $1,500 rents, that's very unlikely. Now, again, it can happen, right? I'm giving a lot of caveats, but it's really understanding the play here and what it looks like. From that, nearby comps, right? I know a lot of people on the call are probably familiar with just residential, right? The way you value a house is you're looking at the houses in the neighborhood, what they sold for. The way we value multifamily is a little bit different. I'm going to go through that on the next slide. But understanding at least what are the deals in the area, what are they getting for rent, it works. It doesn't work for the sell price, but hey, the property across the street's getting $1,300 rents. They added backsplash, black appliances, whatever, and they got it. Okay, great. If we do that, theoretically, we should be able to get that as well, right? And again, digging in, understanding the median income, rent growth, and average vacancy rates. These are the last three are very market specific, but there's something to understand. And so, there's a couple of tools out there. City data is one that we love. You can dig in and really do all sorts of visuals on income and, and where things are at and where the good parts of town are and where the bad parts of town are. Get in and understand those things, right? And there's a couple of other tools listed on the slide deck. Next up, right? And I think this, in my mind, is the value slide. And I'm going to spend a lot of time probably going through these because, everyone can understand, okay, great. Austin's an awesome city. It's growing like crazy. Here's a deal in Austin. Now, how do you decide that that's a good deal, right? I think everyone can get their head around the job growth, the population growth. Those are easy things to understand and get past. Where it gets hard now is once you get into the financials and the numbers and what does that mean, right? And so I think as a passive investor, these are questions that I've had people ask me, and you should be comfortable asking, your sponsors and try to, understand. And again, most passive investors aren't going to know how to model the whole thing, but things need to make sense, right? If the income today is per unit is $900 and tomorrow they're going to say, oh, we're going to get $1,500 rent. Ask yourself, is that likely? And maybe there's a valid reason. But again, you're just trying to get comfortable with the actual strategy and understand how, you're trying to understand where are they getting aggressive and where are they maybe not, right? And so, this is where you want to, ask for the T12 on the property. So T12 really just means trailing 12. It goes through the past 12 months of income and expenses on a property. And as a passive investor, you want to see the property the past 12 months has collected, $3 million, right? They're saying in year one, they're going to collect $4 million. Does it make sense to collect 33% more rent? It's absolutely impossible. I mean, unless the property is completely vacant. And we've had a situation where we bought a deal that had a third of the units were down units, literally physically not functional. And I had an investor say, oh, look how much you're pushing the income. I had to tell him, all I got to do is bring a third of the units online. Now my income for those units goes from $0 to $1,000, right? And so there might be valid reasons and, get comfortable with it. And that's coincidentally, that's a deal that we're selling right now. So that'll be sold end of December, early January, right? So it's about understanding the story, and maybe there's a valid reason, but you're trying to understand what leaps are they making, right? Maybe I could have said, hey, maybe it's a deal with no down units, and I'm just going to push rents. Maybe I have a justification, right? I've seen deals where they get $400 or $500 rent premiums. That's amazing, but those are far and few in between. Continuing on, right? Reversion cap. This one is important. And I think this is, if I was to say any one number in a model that I change, reversion cap has the biggest impact. So I'm going to explain this one really, not maybe quickly, but I'm going to spend the time to explain this to everybody. So in commercial real estate, right, the way real estate gets valued, right, is based on a cap rate. You have to ask yourself, how do they know that the Walgreens down the street, how much that is worth versus the Chili's across the street versus the apartment down the street? Three very different asset classes, right? Really, cap rate is how they value them. It's very different than residential. Residential, you have a lot of houses in a neighborhood. You can easily say that house sold for this, this should sell for that, right? With commercial, you're looking at the cap rate. Now, what is the cap rate? Well, cap rate, what it means, right, in its dead simplest explanation, I hope this is easy for everybody because I've explained it a million times, and so people say it's a good example, right? If you bought a property all cash, right, and you did nothing different than the current owner, how much return would you get? That's what cap rate means, right? And so to give you an example, right now in Houston, multifamily is pretty much, let's say it's about a 5.5 cap for C properties, right? 5.5%. What does that mean? That means if I bought the property all cash, so take debt out of the picture, there's no debt. It's just I brought it straight cash and I didn't do anything different than the current operator. So maybe the operator didn't manage it well. Maybe they left it 75% occupied, right? If I did exactly what he is doing, right, and I got the same income he got, my cap, my return on my investment is going to be 5.5%. That's what cap rate means, right? Now, that said, right, it's a way to measure different types of assets against each other, right? Now, we do things to juice it, right? We do bring debt in, right? Debt means that instead of bringing $5 million to the table, maybe I bring $1 million, right? Other things that help juice my return, so I'll make more than 5.5%, right? But cap rate just means if you bought it cash, that's what you're going to get. Now, what is a reversion cap? Reversion cap means it's whenever you're buying. So at the beginning, I mentioned that Houston right now for C properties about 5.5, 6 cap, right? So properties are selling for 5.5%. And actually, sorry, the other thing I forgot to mention is how do you calculate cap rate? It's really the income over the value equals the cap rate. I forgot to mention that. A really important piece, right? So again, my NOI, my income over the value equals the cap rate. So I'm going to make up numbers. Let's say a property made $1 million in NOI and I bought it for $10 million, right? That means the cap rate that I bought it at is a 10%. If I know Houston is a 5.5 cap market, that's a steal. That deal's a home run, right? Because I'm buying it at a 10 cap, even though the market is a 5.5 cap, right? But now let's do the inverse. If let's say I know my NOI is $1 million, right? It still collects $1 million. I know that Houston is a 5.5 cap, right? I should be able to calculate the value. I don't know what $1 million over 5.5% is, but you guys get the idea, right? It's I think it's 5.5 million. So that deal should sell. No, I did the math wrong. Sorry. I don't know what the math is, but really it's a way, you can kind of gauge what a deal should sell for. So if I'm buying it at a better cap, it's a good deal. Now, the problem is cap rates are market driven, right? I don't know what the cap rate is going to be in 5 years whenever I go sell a deal. You just don't know, right? Maybe the economy is doing great, maybe not. And so reversion cap is essentially the sponsor trying to take an estimate as to what the cap rate will be whenever they go to exit the property, right? And so, there's rules of thumbs on this, right? From anywhere from, 5% to, higher per year. It gets very complicated, but you wanted to understand the simplest thing, which is usually if the market is 5 cap, you assume the market's going to get worse than it is today. We're still in a strong market. Take COVID out of the picture, right? So now I've seen deals where they're buying it at a 5.5 cap, and they say whenever we go sell the property, we're going to sell it at a 5 cap instead of a 5. We bought it at 5.5. Now we're going to sell it at 5. Guess what? That 5%, that 0.5% increase in the cap rate. If you think of my equation, it's NOI over the price point equals my cap rate. If you divide $1 million NOI over 0.5%, it's a huge amount of increase in the potential selling price, right? And so most deals, you should actually see it the other way around, where they're buying it at a 5.5 cap. Maybe they're going to model it as a 6 cap on the sell, right? It's a really easy number. You change it just 0.5%, it can drastically improve the returns. And so you as an investor, simplest thing is you want to see the cap rate increase, right? So they buy it at 5.5, it's going to 6. That's step number one. If you really want to dig in, understand what the market is and how are they justifying where they're going to get to for the cap, right? And again, it's kind of loose because, a deal that makes $0 does not mean it's worth zero. It's not, it's a zero cap, right? But that's a very big one because, again, just 0.5% can change the total returns millions of dollars. And so that's the biggest one that I see a lot of sponsors will tweak and try to make a deal. They stretch, try to make a deal work, right? Another big one is escalators. So as I mentioned in the beginning of the call, right, a naive approach to real estate is a person that searches and sees real estate appreciates 2.5% a year, right? And so, we call those escalators, right? How much increase are they modeling each year in rent? And how much are they modeling each year with expenses, right? Due to inflation, right? Most deals are 2 to 3%. I've seen deals where they say, you know what, we're going to get 4% increases every single year. That's not likely. Why do you think you're going to get that, right? And really, again, that extra, if you think about it, going from 3 to 4, that's an increase of 30%, right? More potential increase of rent. And so it can really change the numbers. As an investor, you should look at that, really understand that. And again, most modeling is 2 to 3%. And even with COVID, you kind of simmer down the first year right now is kind of what most good modeling I'm seeing. And then from that, right, average annualized returns, most deals, they're looking from 15 to 20% a year. Internal rate of return, that IRR that I said, again, that's really 11 to 18% is where I would say that number is today. Cash on cash, again, cash on cash. So for those of you that maybe are new to real estate, cash on cash, what it means. So if you remember what I said about cap rate, it means my non-leveraged cash return. Well, once you're leveraged, right, things change. Now you have debt service to pay. So cash on cash really means based on the money that is invested, what is the actual return, right? So that's what cash on cash is. That's really a critical number. That's one of my biggest numbers I like to look at. And again, today, most deals are 7 to 12%. Most deals are doubling in about 5 to 7 years, right? These are just very, very high level kind of average returns that you see today. And last but not least, preferred returns, right? I think this one's a really big one to understand and look for deals that have it, right? We didn't start this way, but now all of our deals we do have preferred returns. What is a preferred return, right? That's the first question. All it means is that you as an investor get preference on returns. And so, before these sponsors make any money, right? So if you really think about it, if you have a deal, right, we have deals that are 8% preferred return. What that means is that whenever we distribute cash, whether it's from cash flow or sell of the property, right, we have to make sure our investors have gotten 8% return each year, right, on throughout the whole hold before we can take any of the splits, right? Because most of these structures are, I'm going to go over structures in a second. They basically, there's a split between the investors and the sponsors, right? We make money on the upside, right? So we got to perform for our investors, and then anything above goes to investors. So that's what a preferred return is. You see this in the 6 to 12% range. It really can vary depending on the asset class, depending on what the splits are, right? I think the thing that's missing from this slide is really the splits. And so a lot of times, you see about, I'd say 6 to 9% preferred returns with 60-40 splits to investors. So meaning 60% to investors, 40 to sponsors, or 70 to investors, 30% to sponsors. All right. Next up.
Real quick, Feras.
Yeah.
Real fast. Sorry. Hey, everyone. I know you're asking him a lot of questions. Feras, you have a ton of questions. Guys, we're going to get to all your questions at the end. Keep them coming. Keep putting them in. I promise we're going to do a small Q&A right at the end. Feras, keep going. Sorry.
Yeah, no problem. And yeah, to your point, definitely everyone, please ask questions. I will moderate and kind of go through these. Me and Derek, I'll have Derek answer the easier ones, and I'll answer I'll have Derek answer the harder ones. I'll answer the easier ones, but we'll figure them out. And so, again, we're doing this for you all. So please ask questions. So continuing down, right, vetting the investment opportunity, right? Ask the sponsor, are they investing in the deal? I've seen sponsors that make money on fees and they don't care about the deal, right? We invest in every single deal to show, look, we're sitting on the same side you are. We, not only will we make money on the upside, we actually have money in the deal. We need to make sure the deal is going to perform, right? Not all sponsors do that. Talk to your sponsors, right? Understand how the deal is structured. I mentioned the preferred return earlier and splits. And so again, understanding what that dynamic is. Next up, what's the expected hold time, right? Unfortunately, real estate is an illiquid asset, right? And so, it's not easy to make an exit. It's not to say you can't get your money back out, but it gets tricky and you need to find someone to buy it. So understanding just what is that horizon. And maybe one thing that's not on these slides that I think is kind of important is the way a syndication works, which is what I'm talking about. Syndicating means pulling people's money together, right? Was we create an LLC that buys the asset. The investors are all shareholders in that LLC, and we are just operating that LLC, right? And so really you have shares of the property. And so you have to figure out how to sell those shares if you need to get out earlier. Additionally, kind of continuing on, understanding just what fees will occur, right? When are there fees? What do those look like? Again, a good sponsor is very transparent. Understanding what is the business plan, right? Maybe the deal has down units, like I said, and the goal is the deal that we have right now in Atlanta that we're going to sell. Literally, the entire business plan was just all we got to do is get 30 down units online, 52 units in the property, get 30 units online, and we are killing it, right? And we did that, and we actually got increase of rents, which is just an extra gravy on top, right? But understand that versus maybe buying a nice asset right in the Galleria, the returns are going to be low. The business plan is just to hold on for a long time and pay down the debt. Very different kind of play. And again, what are the returns they're projecting, and ask them for the modeling. How do they come up with those returns? Right. So continuing on, right. Next up is really the investment process, right? And so, what to expect. So during the closing, right, review the deal. The sponsor will give you what's called a PPM and an operating agreement. Please read the PPM. Please read the operating agreement. It explains how everything will work. It explains what you are entitled to as an investor, what the sponsor is entitled to. It explains what your voting rights are, if any, right? Read your operating agreement, please, right? And so it's important. And really with that, you fill out paperwork, the sponsor vets it, and then you wire funds, right? And so you pull together all the money, and then, we have the closing, right? There's a title company, all of the shebang, there's lawyers on every side, getting all the paperwork done, getting all the legal done, all the title, all that. But then we close the property. From that, right, during the hold as an investor, expect investor updates. We do monthly updates to all of our investors, right, which is really a written up, detailed information with all of the financials of every property. Some sponsors do quarterly, some do 6 months, some do annually. Understand what they're going to do and know to expect that. And again, looking at distributions, right, how often do you do the distributions? It used to be that we did distributions quarterly because we thought it was actually, a burdensome process, right? Doing all the paperwork. We've actually moved to monthly distributions because we've since systematized it enough that it's boom, boom, boom. We like mailbox money, and we can do distributions monthly, right, on deals that are distributing. So kind of, again, as an investor, really that's the gist of it. And maybe one piece that's not on here that I think is important, right, especially for kind of the audience, right, is at the end of each year, we give you what's called a K1. Right, a K1 is the tax document. It's like your W-2 if you have a W-2 job, right? That basically says K1 is what you get if you are a shareholder in an LLC. And so we actually pass through depreciation to you. And so you'll get a K1. It'll say how much you've collected, but also how much you've lost, and you'll be able to apply that to your taxes, right? If you're investing with your IRA, it's a little bit different, but again, the same principle, right? But that's really it. As an investor, that's really all that's involved during the hold. Now, during the sell, right, there's, some things to think about. Maybe there's voting rights, so you have to vote, right? The sponsor will take a vote. Hey, we want to sell. Does everyone agree? Maybe not, right? There's the process of returning capital, which just means your initial investment. And then there's the process of returning profits, hopefully, right? So that's the high level, what it looks like for investors. So with that said, right, my name is Feras Moussa, for those that missed the beginning, right? Feel free to send me an email, feras@disruptequity.com. Always happy to help answer questions. And before we go to Q&A, I know Derek mentioned QuestCon earlier, but first 5 people that are interested in QuestCon tickets, send me an email. I will cover the cost of that. And so, first 5 people that are interested, we'll go ahead and get them kind of QuestCon tickets.
That is freaking awesome. So I don't know if you guys heard that, but I talked about our QuestCon event coming up here this week. Remember, the tickets were, if you use Haley's coupon code, they were $50, but Feras has said he'd cover the first, was it 5 people?
5.
Yeah, 5 people, and he'll get you guys a free, and he'll cover your costs for it. So send him an email about that.
Yeah, please do.
Yeah, thank you for that.
No, thank you guys. I mean, great event, good group of people, and sponsors, and so as an investor, I guess what I like about events like QuestCon, it's all about getting educated. I tell investors, go get educated before you put your hard-earned money into something. QuestCon helped facilitate that.
Absolutely. So you have a ton of questions.
All right.
I'm going to go and just kind of go through some of them with you.
Go for it.
I'm just going to let you answer, and kind of, we're going to see what some of these are. So how do you go about looking for some of the info, like the vacancies rates, the nearby comps, those type of things? What are some good resources that your team uses for that?
Yeah, so that's a good question. So, we actually pay for a service called CoStar, right? It's expensive. Most passive investors won't get that. but you could ask a sponsor for a CoStar report, right? You could talk to the brokers, right? And as a passive investor, once you decide I'm going to invest in B properties in Atlanta, you're going to start to know what Atlanta vacancy rates are, right? And really, another good way is look at all the deals that people are doing in those markets, and you'll get a sense of what the vacancy rates are. And honestly, something that I've done, and I know people could do, is just pick up the phone, call properties. Hey, how vacant are you? How occupied are you? Right? Like, I mean, and we had the team do that. We're doing due diligence on a property right now, and our team didn't agree with the rent, so we called and found out that they're including a $25 trash valet fee into the rent. And so really the rent was lower, right? And so pick up the phone, guys. Don't be scared.
Yeah. So one thing that kind of led straight into that was the cap rates, right? How do you guys, and God, I wish I could remember the formula. I used to know it when I was looking at some commercial properties for myself, but like, how do you determine what the cap rate is?
Yeah, that's a good question. So cap rate, man, how do you determine? You get this feeling inside over time, right? You just know a market well enough. And so for those of you hearing the beeping, that's all the people that are emailing for tickets. So appreciate it. We'll definitely get that to you all.
I want to get into that.
Yeah. But back to the question about how do you value cap rates? Talk to a broker. Literally, brokers are social people. Just call them. Hey, what's the cap rate in Houston? There is data out there. Look at IREM. I don't know, stands for Investor Real Estate something Management, IREM, right? They have posted data. I know a lot of the big, Yardi does a big report, CoStar. A lot of the companies do publish cap rates in markets. And so the data is out there, right? And you can see charts and how cap rates have been trending. And lately, in most big markets, cap rates have been compressing, meaning it used to be a 7 cap. Now it's a 6 cap. Now it's a 5, right? So that data is out there. Take a look.
That's awesome. And so as we go through, how important is it to consider the price per unit when comparing deals that are similar in the markets, like Class A to A or B to B, C to C?
All right. So I just realized it's Omar asking. So, hey, Omar, long time to see. I do know you. All right. How important is it? So I think price per unit is the simplest way we evaluate properties, right? Because you're really trying to understand for that unit, that one piece of rent, how much, if I'm buying a property for $80,000 a unit, right? For those of you in the residential space, the 1% rule kind of applies, right? In residential, there's the 1% rule, meaning if I buy it for $120,000, I need to be able to get $1,200 of rent, 1% of my purchase price. So I use it as a very high level way to gauge properties. And so we always break it down. What is a per unit price and what is the price per square foot? Another one that I do like to look at, right? So I think it's very important. That's really the metric. But again, you're looking at the holistic thing because debt plays a big part. Our deals work because debt. So you really have to look at the whole package. But it's a good indicator of, okay, the property across the street sold for $80,000 a unit, but maybe my property's got micro units. And I've seen these. This is the new trend, guys. Newer deals like in Austin, I saw this one property, 400 square feet units. It's insane. I mean, so it's not just price per unit. That's one indicator, but also price per square foot's another really good one to dig into.
I like that. So someone asked, I know it's easy to ask the questions that you're mentioning throughout your presentation, but is there a good way you can verify the truthfulness, right? I can say anything I want, but is there good ways to really verify that someone's actually claiming what they claim?
Yeah, that's a good question. I mean, this is where, as an investor, you need to do your own due diligence, right? And ask them what they're doing. And, and I'll say this candidly, my investors invest because I said it's a good deal, right? Meaning most investors aren't going to do all their own underwriting, all that. Fundamentally, they're betting on me, but they've built a relationship with me. They've gotten to know me. They've invested in 10 of my deals, right? And so that said, if it's a sponsor you don't know, right, you do need to do your diligence because, again, most people don't wire these big of chunks of money for anything besides buying a house, right? So it's hard-earned money. And understand the sponsor, what they've done. And that's it goes back to what I said, ask the hard questions. Try to verify what you can, right? But if you ask a person for a T12, if it's PDF version, yes, they can forge it. But again, that's very illegal, right? Now you have grounds to sue them. So that's a whole different type of thing. So let's take legalities out of it, right? But if they say it's a 5 cap market, you can call a broker, go understand. Maybe the broker says, Houston's more of a 6 cap market. Okay, great. Then you ask the person, well, hey, I'm being told it's 6. Is it 5 or 6 and why, right? Maybe they're telling you, I guess there's some level of trust. I guess if you don't trust a sponsor, you already have a problem, right? Don't even waste your time. Maybe it's the first problem, right? Then from that, ask the questions and ask the hard questions. I've had investors tell me that they've asked sponsors for things and the sponsors won't even give it to them. I'm like, are you kidding me? I didn't even know that was a thing, right? So if a sponsor won't give you some data,
Red flag.
red flag. So
No, and I think that brings up a good point that I think one of the ways that I've, as an individual, done deals, and when I do due diligence, is I look at, well, how many deals have you done, right? And if I see this is their first deal, I get a little hesitant. Not saying it's good or bad, right? Everyone has to get through that first hump. But if I go through and I'm like, oh man, this group has done 10 investments in the last, few years, like that's a good sign because this means that they're very consistent. So I think sometimes that's what people are looking for.
Yeah, and there's nothing wrong with betting on the new horse, right? But just understand you are, and it's okay, right? Maybe you bet differently if it's the proven horse or the new horse. And so, it's about, a lot of real estate is not about right or wrong. It's about giving investors the information so that they can make their own decisions, right? We're all adults here. It's about letting people make that decision.
So that kind of leads to the next part. Should an investor demand a greater rate of return for investing in a new apartment in a transitional type of area?
Yeah, so this is a good question. And maybe I'm going to ask it a little differently, right? I don't just look at returns. I look at risk-adjusted returns, right? And what does that mean? It's things that add risk, meaning if I'm doing a ground-up development deal, I need more returns than if I bought a stabilized deal. Why? Because there is inherent risk in doing a development, right? There are things that can go wrong. It could take a year instead of 6 months. The debt could blow. I mean, there's a lot of things that can happen, right? And so I need higher returns. Just like if I do a C-class property versus if I have C-class and an A-class property, both have the same returns. I'm going to go for the A always because, again, a newer property is less risky inherently. C-class properties, I can't tell you guys how much we've spent on plumbing. It kills me. Plumbing and deferred maintenance, things happen. A-class properties, it's a lot less risk. And so I need higher returns, and we look at that very carefully, right? And that includes area. We were looking at a deal in Galleria, which is usually not ever an area that we look at because it's too expensive, but it was an amazing deal. The returns made sense, right? It was less than my normal, but it's still a very good deal, good location. And so, you do need to look at risk adjusted. It's not just about returns, right?
And Omar has a ton of questions for you. Omar, we're going to get to some of those in just a minute. I like Omar. So what is your portfolio and how many properties have you closed or have you kind of gone through? Like when we think of these type of cycles, you as an individual or your company?
Yeah. So I think we've done 10 deals and we've sold 3. So we have 7 left. I think.
Nice.
Right. Or maybe 11 and we have 8. Yeah. One or the other.
Okay.
And so, so our properties, we're buying properties from 100 to 400 unit properties, right? So, from the big to the small, not really. 100 units. We don't do anything less than 100 usually, right? Our smallest deal we have is a 90 unit deal. But ultimately, if you're kind of below 90, it becomes not scalable because really, we have full-time staff at the properties, right? And if you have, let's say you have a 40 unit property, people always talk about buying a 30 unit, a 40 unit. Heck, I almost bought that as my first multifamily way back when, before I bought, after the fourplex. But you realize is that the problem with that size is you can't, there's not enough meat there to support full-time staff. So it's in this weird spot between who do you use to property manage? Do you use the property management company that only knows how to do residential and can't really do 30 and they're going to try to do it, right? Or do you use the property like my property management company? We do third party now, but we won't do a deal that small. It doesn't make sense, right? We need to have dedicated site. So very high level rule of thumb, for every 100 units, you have one person in the back office, one person in the front, meaning you have one person in the office, the leasing, and you have one maintenance person.
Man. So I like this. I kind of skipped through them, guys. I'm skipping through the questions. I'm trying to keep them organized into so they kind of flow nicely because there's a ton of them out there. But after you close the deal, what is the typical time frame when an investor should expect to get some sort of, I'm going to go ahead and say a distribution. It could be a dividend, however you want to label it. And they label this after closing a deal. So I'm going to change their verbiage and say, after I give you my money, right?
Okay. Well, the closing is the better way to ask it because things happen. So to your point, right? Most of the time we raise the money about 30 days before closing, plus or minus 15 days. So usually it's 30 days till we even close the asset. So the money is kind of just sitting there. We're raising all the money, right? And it's funny. I had to educate we have a great relationship with a bank here in Houston, and having to educate them how an account will go from $0 to $8 million in 30 days. It's like, well, where's all this money? But the money sits there, right, until we close. Then that goes to title. Now we close. So now we own the property, we can start implementing the business plan. That said, different deals do different things. We've had deals that we've told investors no returns the first year because it's a huge, value add. We're totally repositioning the property, right? But we're going to sell after a year. We're going to refi after a year, and it just depends. We've had deals that we've sold. Basically, the deal right now in Atlanta, we're selling right now, no returns. That was a play, positioning, no returns, but we're going to make an exit and it's going to be, significant 80% return in 18, 12, 16 months, right? But we have other deals where we say, hey, this deal, there's going to be cash flow really early on. That said, the thing I caveat people is it takes time to do, a value add, right? You have to wait for people to move out. You have to get the crews in there to go upgrade the units. You have to rent them. And so usually you have some deals that'll pay distributions from day one. And I've seen these deals where they pay 8% the very first month. It doesn't make sense. Financially, it's impossible. So what they're doing is they're over raising the deal, right? They're raising more money than they need, and they're giving it back to investors on distribution, which we don't do that because now I'm giving investors their money back and they have to pay taxes on it. It doesn't make sense, right? For us, we're very candid. Here's how long it's going to take. And so ask the sponsor what they're expecting. And so some deals, again, some deals I've seen that have no returns for 2 years, but then they're, home running it at the end with a big refi and everyone gets 100% of their money back and they're going to hold on to the deal for life, right?
Which kind of brings back to that thing that I know you mentioned up a little bit ago during your presentation was read the PPM or the operating agreement, right? That's why you give it to them. And people, they don't read them. I don't get it. If I'm going to give you $50,000,
read it. And then that's where, as a sponsor, you have to at least outline what you're pitching, what you're saying, right?
Absolutely.
So, there's a lot of compliance things there. So read the PPM. That'll explain what the sponsor is trying to do. Now, if someone's asking me, what is a market rule of thumb? I mean, again, it varies, right? It's very, very deal. And it's up and down from the spectrum from quick cash flow to no cash flow to something in between.
Hey guys, so we still have way too many questions. I'm not going to be able to get to them all, so I'm going to ask Feras here a couple more of them, and then make sure you get his email right now. You can email him these questions. You can email him directly. He'll work with you. He's here for you guys. So make sure you grab his email right now. That way he can work with you all.
Happy to put them in touch with someone for the team to help answer them too, if there's too many for me. So
yeah. So real quick, what did you say the typical splits are between GP and LP? Can you explain that one more time?
Yeah, so the question is, first of all, let's explain to people what is GP and what is LP. LP means limited partner, right? That's usually our passive investors. GP means general partner. That's the sponsors, the syndicator, the managers. There's a lot of names for it, right? Now, most deals today, right? And again, I've seen up and down the spectrum. There are some people that make more on one deal than we make on 5 because they are squeezing all of the juice from their investors to themselves, right? We have what I think is very fair splits, right? And so what we do on our deals is usually we're doing 7 to 8% preferred return, and then a 70-30 or a 75-25 split after, meaning 75% to the LP, the investors, 25% to us, right? And that's after they've gotten their preferred return. And maybe one other thing to mention, people understand if your deal has what's called a catch up or not, right? Meaning, this gets into some of the mechanics, but essentially, we give our investors 8% return, then whatever's left over, then we're splitting that. We're not doing a catch up where we're trying to get up to 8% also or any of that stuff. So, but some people do. Some people do 50-50 splits. Some people do what's called the waterfall. So people have heard of a waterfall. Waterfall means it's 2 different tiers, 3 different tiers. And really what it is saying, hey, investors,
they always confused me. I'm like,
yeah. So to really simplify it, it is complicated because they do it based on IRR, which is itself a very complicated thing. But the simplest way to think about it is, hey, Derek, you invested $100,000, right? And let's say, we sold the deal tomorrow, or, say after 1 year, we sold the deal and we doubled everyone's money, right? And so I might've done a waterfall. Let's keep it simple. Let's say I said, hey, I'm going to do a 75%, 25% to me, right? Until you make a certain return, right? So let's say you were the only investor and the deal made $200,000, right? Profit. So you already got your capital back, but you had invested $100,000. That was your initial risk, right? So now maybe I'm saying 75% to you, 25% to me until you make 50%, right? So now you're happy. So now you're getting $150,000, right? And there's $50,000 left after that, right? And then whatever's left after that, maybe I'm splitting it 50-50. So what it does is basically a waterfall helps the sponsor make more on the crazy upside, right? I did my example a little bit bad. It gets kind of tricky because
I was like, and that's why the waterfalls, anytime I've seen those come in from investment documents, I'm always like,
All it means is that there's a split up until the investors have made a certain amount. And after that, any money left over is being split at a better split. And so we have a deal where we home run it. I mean, insane amount of return. I wish we had a waterfall on that deal, right? My investors made unbelievable returns on that deal, right? But really, we should have been rewarded for that crazy upside too, right? And so what a waterfall does is it helps, for the deals that are insane, it helps kind of, I guess, a sponsor make more money, just to be candid, right?
Thank you. So real quick, guys, grab his email address. Feras, can I get you to stop sharing your screen for 1 minute?
Absolutely.
And I'm probably gonna embarrass you just for a second, because so what's really funny is prior to us starting this event and actually clicking start and go live, is me and Feras were talking just for a minute. And if you guys, I'm going to ignore 2020. 2020's been a weird year, okay? But in 2019, Quest attended or hosted somewhere right around 650 or 680 events. That's a lot of events, just so you guys know. All right, that's almost 2 a day. All right, that's how many events Quest was either putting on, or we were attending, we were sponsoring. And I would easily say, out of all those events, in the top 10 by far was a specialized event that we got to go to, and it's this one right here. Do you know anything about this event, Feras?
Yes, I do. So this was our Multifamily Investor Network. So maybe to give people some context, right? We are big believers in education. Investors need to get educated, just like you guys believe that. And that's what we love about Quest IRA, right? Before we take any, we want people to learn what they're getting into, because real estate is inherently a little bit complicated, right? And so we had this crazy idea in 2018 to put on an event, essentially in Houston, Multifamily Investor Network, right, is what we called it. And really, the idea was just something in Houston. There was not a good neutral event in Houston, meaning come one, come all. We're not part of any group, right? We are very, we're neutral players, right? And putting it on, but with a big kind of education piece to it. And so we did that last year, and we ended up, it went really, really well. You guys were one of the best presentations there, because again, a lot of our investors didn't know about investing with your IRA. It's a great mix. And, then we ended up doing 2 more. So we did one in San Francisco, then we did one in Boston. So that was 2019. 2019. And so then 2020, which was this year, we did one in February, right? We had the mayor of Houston come out, 400 people came out to this event. And, then COVID happened. So we ended up not doing San Francisco and Boston again, but we decided we are going to do one again in 2021. It's going to be February 27th. And I think that's what you're showing. So, really our goal is, we don't make $1. We probably lose money on every one of these, but it's really about getting people exposure, right? For us, it's about, if we break even, we're happy, but getting people together, networking, meeting people, and, trying to bring cool speakers, right? So the mayor, it was awesome to have him out, did a great job. And it was just kind of, it's interesting to see their vision of what they're trying to do in real estate from kind of a political perspective, right?
Mm-hmm. So, and that's why I just want to take a minute and bring it up, because this event was really unique for Quest. When we got to attend it last year, man, Quest really was excited. We met so many, not only good investors, but educated people. So if you are brand new to this area, if you have a lot of questions, this is a great event to attend, just to go ahead and get educated without being sold on something, And so I just want to thank you for not only coming on, but hosting those type of events, and you coming in and educating our clients as well. And before we let everyone go, you may have already been hit with the 5 people, but you said you're giving 5 people, you're going to cover their QuestCon tickets if they sent you an email. Could I get you to post your email address real quick in the chat box?
Yeah, absolutely.
Yeah, awesome. And then so everyone, make sure you grab his email. Did you have any closing remarks or anything before we close out everything?
No, I mean, really, the only remark is thank you guys very much. Like I said, you guys, it's funny. I've seen you guys grow. I remember the first event I went to many, many years ago, and it's been awesome to see you guys continue that and really do it in a very similar mindset to what we, the same vision that we have, right? Getting people educated, and that leads to opportunities. So. And
that's the thing, is an educated client will do more investments than people ever realize, right? So if you're educated, you understand what you're doing, that's who everyone should be working with. So Feras, thank you so much for coming on. We really, really do appreciate it. Guys, grab his email. It's right there in the chat box right now. I'm going to leave it up for an extra second. And don't forget, if you would like a QuestCon ticket, I saw Sarah right now. She just posted the link below. All you have to do is click on it, type in the coupon code Haley30, okay, and it will give you an extra discount. If you haven't emailed Feras yet, email him, and he may, I'm going to say may, be able to cover that ticket. I don't know how many people have already reached out to you. So
Yeah, I'll
thank
take
you
a
again
look,
for
but
coming
yeah, we'll
on
make it happen.
our $1 trillion mixer, man. You're
No
awesome.
problem. No, thank you guys very much. I definitely appreciate it. So
Yeah.
hopefully everyone enjoyed that, and thank you all.
Yeah. Thanks, everyone. Have a good evening.